students participate in more number of startup events, etc. Sir. Presently, we are having certain prototypes, but these students are much more. They do not have the knowledge of getting some funding, etc. And I got your name from Professor Panda sir from Pragati Engineering College. Now, ours is Raghu Engineering College, sir. I think you might have known our college very well because we are very near to you, sir.
Yes, sir. With 3 lights.
Yes, sir. Now, ma'am, Swati ma'am, kindly take over the session to introduce the guest.
Sure, sir. Sure. Shahim Javed, sir, welcome to the session, sir. Good afternoon, all. Myself, Dr. A.V.S. Swati, Associate Professor, EC Department, Innovative Ambassador, Institute Innovation Council. On behalf of Raghu Educational Institutions, I welcome you all to the online session organized under IIC on angel investment and VC funding opportunities for early stage entrepreneurships by Professor M. Shahim Javed Garu, COO IIMV, Field Visakhapatnam. I take this privilege to introduce about our chief guest. Professor Shahim has done his PhD in finance and accounting area in IIM from IIM Indore. Prior to joining IIM Visakhapatnam, he was working as an assistant professor at MDI Murshidabad, where many students, UG, PG and PhD students have been benefited by his teachings. He has also worked at SunGard for over 5 years as consultant in various domains such as public sector, finance, information and knowledge management. His teaching interests are corporate finance, corporate governance, valuation, startup finance and finance analyst. His research interest primarily lies in corporate finance, governance, capital market, entrepreneurship and tourism domains. Shahim has been training and mentoring startups and molding them into implementation phase since the last 3 years. As a program director, he has successfully incubated 40 plus women ventures under Women Startup Program being funded by NSTEDB, DST and Goldman Sachs over the last 3 years. He also heads the G3 TBI at IIM Visakhapatnam under the TIDE 2.0 program. IIM Visakhapatnam since now have incubated 5 ventures under TIDE 2.0 scheme. He also actively trains the faculty and administrators of various government funding technical institutions on various aspects of entrepreneurship, development and academic institutions under the Technical Education Quality Improvement Program, TEQIP, under the aegis of National Project Implementation Unit, Ministry of Human Resource Development, Government of India. He has been actively sharing his knowledge and known in the entrepreneurship space as keynote and invited speaker at various forums like ELIP, Vizag Chamber of Commerce, TIE, AU, NASCOM, among others. It is our pleasure to interact with such an eminent personality. So without any further delay, I would hand over the session to Javed sir. Thank you all.
Thank you, madam. Very good afternoon to one and all present here. And thank you for inviting me. Please let me know in any point of time if you feel my voice is not very clear, you are not able to hear me. I will try and adjust my volume at this from my control. So what I will do is I will quickly one second. Yeah, I'll quickly share my screen with you. Okay, just give me a minute. Share your screen. There's something which I need to fix. Just give me a moment. Hello.
Yes, sir.
Okay. Yeah, something was a problem. I guess I just had to. I'll just share my window. Are you able to see my screen?
No, sir. We are not able to see, sir.
Nothing is visible on your as a screen share.
Your video only, sir.
My video only. Okay. Something is just presenting. Can you see now?
Right side top, there will be share like button, sir, beside leave.
Yeah, I've clicked that, and it says that it is share.
Screen. You can share screen, sir, directly, not window. You can share screen.
Okay.
By clicking it, you share screen, sir.
Yeah, so there are two options. One is screen, one is window. So I selected
Yes, screen.
the
Screen you select, sir.
Yes, I selected it, and then it says presenting.
Yes, sir.
Yeah. So now can you see it?
Wait, sir, 1 minute, sir. No,
Sorry,
sir.
I don't know why it is. Shall I just share the PPT with you, sir?
Yes, sir. You can send it to me, sir. I will share it.
I will just.
Raghu, ఒక్కసారి ఈయన
Sir, I shared it with you.
Sir, you sent through WhatsApp, sir?
Yes,
Yes.
Yes. So what I'll do is I'll start. By then you can just share the
Yes.
PPT. That would be fine. So really sorry about this. I don't know why somehow it's not allowing me. It shows that my screen is getting shared, but you're not able to see it. So, very good afternoon to one and all. Let me just, start this discussion. I hope the presentation will be up soon. So, basically, the first question when we talk about this particular topic is the angel investment and VC funding opportunity is which should come to your mind is that why is fundraising even required by a startup? Now, startup will need fund for a variety of reasons. It can be that you started a new venture, you just need to create your first prototype, and it will need some money to be created. You don't have that money, or
Sir, can you
yes,
see my screen?
yes, I can see your screen, sir.
Yes, sir. 1 minute, sir. Now is it okay, sir?
Yes, I am able to see.
Okay, sir. Thank you.
Can you go to the first slide, sir? Thank you. First, so the previous one, the previous page.
Previous, sir. Is this okay, sir?
This view is fine, I think. Yeah, this is fine. Be it on this slide. I'll see the next, then you change the slide. Right. So startup will need fund for prototyping creation, your product development, or you need to hire a team. Sometimes startups will also need fund for working capital. Now, working capital is a fund which you will need just because you have got an order and you need to, fulfill that order which is given to you. And to be able to do that, you need a lot of money because the order size is big. Think of a company which is trying to build a product which called multi-lakh rupees per product. So for every product which I am selling at a few lakh rupees, I will need at least a couple of lakhs to be able to produce it. And if I have order of 10 such machines or 10 such equipments, I will need maybe 10 to 20 lakh rupees, which as a startup I may not have. And therefore, many a time working capital may become a very important reason for you to raise fund. Legal and consulting services, you'll have to pay for it, even if you are, into business or not. The moment you register yourself as a company, as with the MCA, you will have to abide by certain prerequisites in terms of regulations, which means statutory requirements are there. You need to do some board meetings, you need to prepare your annual reports, you need to get it audited from a registered auditor and chartered accountant, and then you need to submit the reports to them, which means you will have to spend money in all these legal and related regulatory environment. You need to spend money on raw material, purchasing your equipment, setting up your plant, which is capital busting expenses, or you may also have to spend money on marketing and sales. Right, acquiring first few customers will take a lot of money and effort. Even if your product is just costing 500 rupees, but to convert one customer, initially you may have to spend 700 to 800 rupees per customer in terms of your cost, which you incur in making that sale to happen. Or you will need for your admin expenses, for your office expenses. The bottom is you may not have that money. But even before I go there, I typically would like to start with this question. Do you have clarity of what is a startup? Is it that any small venture is a startup? Or is it that there is any set definition for somebody to be called a startup? So let me go to the next slide and talk to you about the difference between MSME and the SMEs or the startups rather, right? So if I say that any small venture or MSME, small venture, a small company, what is the difference from a funding perspective in terms of how do I differentiate that this company is a startup or it is a MSME? The moment I say that this and why this categorization is important, this categorization is necessitated, especially after 2015, when the government of India came up with a definition for startup, which is a separate entity. Right before that, startups were not known to be a separate entity. Now there is a distinction between a startup and a small venture. So any business which is small may be a small venture, but every small venture may not be in startup, right? Which is the first differentiation. Now, what is in startup then? Now, from a funding perspective, let's look at the difference. The first difference is in terms of how these entities think about their profitability and growth. That's the first distinction between them. See, a small venture, typically an MSME or a small venture, is something which is looking for profitability. They are not looking for growth. Think of any small businessman in your area, in your city. There may be a lot of people who are, let's say I am doing something on glass manufacturing, right? I am the so and so of Saint Gobain in Visakhapatnam area. All the Saint Gobain glasses sold in Visakhapatnam are sold through me. I am the one single point of contact for all the retailers who take stuff from me. In the process, I am also manufacturing some of my own glasses and selling to them, which are basically domestic or industrial glasses. Now, uh, these kind of businesses do not want to they may be manufacturing their own glasses also while doing business for Saint Gobain as a distributor, but they are not wanting to go and compete with Saint Gobain. They don't want to go and sell their glasses outside Visakhapatnam, maybe in Hyderabad or maybe in Chennai or maybe in Mumbai. And why do they do that? The answer lies in the way they are getting funded, and therefore I'll come back to that. Right. The second difference or point of differentiation between these two is the relationship with the funding. Right. That what kind of relationship they have. Do they want to go for a debt funding? Do they want to go for an equity funding? Or do they get a debt funding, or will they get an equity funding? Or they have to go and do crowdsourcing, or they have to get their money from their own known people. So that relationship again is a point of differentiation. MSME will want something different, or rather will get something different than what a startup may want or get, right? And I'll talk about it. And the third one is planning for the end or the exit, right? When I say end, it's not only end of our own business. Sometimes it is end of your own business also, and sometimes it is end of your investors who get associated with it. Now think of a typical MSME. You may have heard that they are doing let's say iron sheet metal work for the 3 generations. They are doing ball bearing for 2 generations. They are doing glass business for the last 4 generations. So typically they don't plan for exit. They don't have a plan for exit in terms of they themselves as a business or for their investors. They have a bank loan. They will continue that bank loan. That bank loan will either grow, it will reduce, it will change from Bank of Baroda to SBI to ICICI, ICICI to HDFC, but they will have a term loan, they will continue with that loan, and they'll continue doing business the way they are doing. They'll not change it, they'll not exit it. Therefore, they don't have an exit strategy. But on the other hand, startup will have to have an exit strategy. Otherwise, they are not a startup. So by definition, if you look at what is categorized as a startup, startup is anything, any small venture, any new venture, which is 10 years and below in terms of their, yes. Is there any question? Okay, so anything which is less than 10 years of age and is doing something which is unique in terms of technology, process, etc., which means there has to be some uniqueness or newness into whatever they do. Now let's understand this. First, let's understand, before understanding their funding life cycle, let's understand their stages of the startup. Now, any startup, as Professor was mentioning, that many of you are actually working on some idea, we are working on some technology, and then you all are looking for funding, right? Which means you typically would be around this proof of concept or business model validation stage, or between these two, where you are trying to figure out something which you want to make, but then again funding is a problem. So if you look at it, your own life cycle, your own journey, you would have started with an idea. That idea may emerge from a workshop, that idea may emerge while you are sitting and having your lunch, or maybe like Dr. Newton sitting below a tree and suddenly an apple falls. And then it stucks you that, okay, there's something which I need to explore further, and that's the germination of the idea. So idea may come at any point in time through organic or inorganic way. But then once you understand that this is something which you are going to follow because you see some potential to it, what do? You look at the technical feasibility of the idea, which is the proof of concept. You want to understand if it is viable, if it can be done or not, right? And that is where, for example, let's say you just was, you came across a business presentation where some professor came and talked about, let's say, carbon nanofiber, that it is so strong, so thin, that it is 1 millimeter cube of that is much stronger than even 1 meter cube of some very strong metal which is available. So this can really transform the way we do a lot of things in the world. And then suddenly it's stuck to you. If this is the case, which means with a very, very thin a connection or a string, I can create a very tall lift which can just take me directly to the moon. So maybe because in today's problem I can still operate an elevator from ground or earth to moon, but the biggest problem is the amount of winding which I have to do. That much ability I don't have because it's a very long thing. But now I'm talking about a very very thin nanofiber, which can be wounded into a small area, and therefore I can still think of operating a lift. Sounds great, and if it does, I have a lot of money which I can earn from people who would want to go using this lift to the moon. Is there a technical viability to it? Can it be done or not? Certain ideas may sound very good, but then again, the technical viability has to be checked. That is where the proof of concepts comes into picture, right? Then is the business model validation. You have an idea that this is how this can be done. How will you make money? Who will pay you? Why will they pay you? How many such people are there who will pay you? How much investment is needed? Will this cash flow which is coming to you will be enough to be able to repay whatever money you have put into the business? How will you sustain it? What are the cost of repairing these things which you will make? Right? Is there any regulatory intervention? Will the regulator charge you anything? Will the space stations charge you anything for this? So there are so many things which the business model validation will help you in. Now, see, till this point, from idea to the business model validation or creation of your first prototype, you are typically just experimenting. You're trying to, it's like a sandbox where you're trying to create something out of it. And you're not very sure about it, but you're just trying to probe. That is where nobody will be very much interested in paying you. Very few cases will be there where people just because you came up with an idea which nobody had thought earlier. It's such a unique idea having such a great potential, and people don't want to lose out on that investment opportunity. That is when somebody will just hook you or invest in you at an idea stage. But trust me, investors do not value idea too much. They value execution equally much, right? And therefore, at the idea stage, you getting funded is very, very less likely. Now, at idea stage, you don't need money also, right? You just dream, you think about something. Where you start needing money is between idea to proof of concept, right? So you came up with an idea that I can create such a lift. Can you show me a technical viability, right, of what you're talking about? So maybe I want to create a small miniature prototype of Earth and Moon, and then try and show the kind of resistance it will have in terms of gravity, after what distance the gravity will be less, what kind of strength is needed, how much winding is required, what kind of a structure will I require, what length of carbon nanofiber string will I require, what cost will it be? Can I put a miniature version and showcase it to test if it works or not with that kind of load which I'm trying to pull up, right? All this will need some money to be invested by you to be able to simulate it, to be able to do it, test it, if it works or not. And that is where your first funding is required, right? Now, who gives you that money? Will you go to the bank? Will they give you that money? Or do you think your friends and family will give you that money? So if this is an idea which came to me and I want to go and talk to anyone from outside who does not know me, they may not have trust on me. So the first set of people whom I can convince very easily is myself, and then my friends and family. So the first money has to be love money. We call it love money. So it has to be people whom you know and they love you, right? Which means they will be willing to believe in you. They will be willing to agree to you. They are the least difficult crowd to get convinced. So you will be able to convince them that, see, this works, and you believe me, give me some money, I want to take it forward, right? And that is where you need to get your first set of funding into anything which you do. Trust me, if I am an investor and you come to me sitting on table with $1 billion idea and you say that you have not invested in even a rupee into it, I don't even want to pay 50 paisa to that business. Because if it is such a beautiful idea, then why are you yourself not convinced? Why have you not put your own money and you are looking for external money to be put into that business? So the first and the foremost rule is start to put your money. It may not be too much. It may not be too much. Let's say your overall bank balance, your investments, etc., are in the tune of 10 lakh rupees. Or let me put it other way: if your family savings and investments are all put across is around 80 lakhs or 90 lakhs, it does not mean that you spend 70 lakh of your money into it to convince somebody that you put your money. But a portion of it, maybe 7 lakh to 10 lakh, if you have a family income or savings investments of 80 lakh, if you don't show that much of commitment also, because you want to take a calculated risk, but still, if you are the one who is leading it, then you should be confident about it, right? So that is the first set of funding which comes, which is friend and family. Then comes the prototyping grant. So once your friend and family gave you some money to do the proof of concept, you did some study, aggregated some material, did something testing. Now you want to go and create the prototype, right? If you want to create the prototype, maybe a large one where you can, do it even before commercially establishing it and selling the product, etc. That is where you will need little more money. It cannot happen just through the lab setup, right? You need in a production environment, you need something which does not only look viable, but it actually acts viable. It shows what it's supposed to do, right? On an electronic circuit, on a design board, I can show that this is how this microprocessor will work, and this is how the circuits will work, and therefore this will do what it's supposed to do. But that is not now required. What is required, that you put them, connect them into the equipments and show that it does function the way you want it to function. That's the prototype. It may not look very good, So if I'm creating a bike which does not have a wheel but a leg, then you need to create one to show. It may not look as good as your Hero Hondas or the Hondas of the world, but it should have a seat where somebody can sit and feel that functionality. That is the prototype, right? So that is the prototype grant which you'll need to be able to do it, and that sometime may be as small as 50,000 to as big as 50 lakh rupees, depending upon what you're trying to do. But then prototyping grant, typically you will not get, in the Indian context, you'll never get anything beyond 10 to 12, 10 to 20 lakh rupees. Typical prototyping grant you will get is between 4 lakhs to 10 lakh rupees is the prototyping grant which you will get. Where do you get this prototyping grant from? See, the prototyping grant typically comes from universities. It can come from incubators which are there in the universities or private incubators. It can come from government grants, or it can sometimes, very few cases, it may also come from very early stage pre-seed, जिसको बोलते हैं, we call it pre-seed round of investment, which is done by some set of investors, which are typically angel or pre-seed round of angel investment, which may happen. But then once you are done with your prototyping, business model validation, at this range where you are trying to work on your marketable prototype, which means you have your prototype basic functionality is done. Now you are trying to create a prototype which looks good, which looks competitive enough to go and sell parallel to a Hero Honda bike, where it does not have a wheel, it may have two legs with which it walks or runs rather, which is fine. It's all good on paper, but the point is now you cannot just have a functionality and go in the market and expect people to buy it. A very funny looking bike, nobody will go and ride on the road. It has to look like a good bike, right? So the look and feel so that it's marketable. You can go and sell it to the consumers is what you need to do. And that is where you explore this product market fit. How do I do? Where do I do? What should be my go-to-market strategy? How do I acquire customers? Shall I do advertisement or shall I do something else? What should be my way in which I will target them, etc. So that is where you will need little more money, and that requirement of money sometimes is even much larger, and that is where the seed funding or the angel investors comes into picture. Now these are the angel, these are the investments which are done at a stage where others are not very convinced of your idea. You're still at a lot of risk. A lot of things are not tested. You're not got into the market. You don't know. It may work as good as functionality which you have thought, but while you launch the product, market may not be very gung-ho about it. Market may not really feel like, it's a wonderful product to really use. Maybe the traditional bike is better than this one. Why shall I even think about it? Yes, it may gives me the feeling of, the sci-fi movies like Matrix and other, but then it may look very funny if I ride such a bike, and therefore there's no acceptance of it. So it may happen that, in spite of all your proof of concept, validation, business model validation you have done, but there's no takers to it. And therefore things fail. So there's a risk associated at that point in time because it is new, it is uncharted, it is unknown. And that is where the angel investors comes into picture. Once the angel investment is done, your product market fit is established, you have started in some city, people have started to acquire it. That is when you need growth. You need growth, you need to expand into multiple cities, and you need more fund to be able to do that. From operation from one city, you want to go to next city, you want to go to next state, you want to go to next country. It will all need a lot of funding to scale up your operations, to scale up your production. And that is where you need more and more money, and that is the growth phase. That is where all this VC funding, which is called, pre-series A, series A and B, etc., will start to kick in. These are the people who will help you in this journey of growth, where you have established your product, you have started selling it, but now you want to take it large, right? And then the story continues from here. Please go to the next slide, sir. Now, in all this journey, one thing which you would have realized is the amount of money which I have to invest to be able to do this. See, when you are doing you are doing nothing, just sitting with an idea, there is no expense on it, right? You just generated an idea, it is in your mind. But when you start to work towards it, so what will happen? The moment the idea came, you would have thought, okay, let's put 2 lakh of my money because that's saving. I'm not using that money, and aggregate all the things which I require to be able to quickly test it out and see if it works or not. Or let me go to a place where ideathon happening on the same topic, and therefore I can test it out. I can sound in front of a lot of people and let them give reactions to it, and that will give me some kind of understanding, etc. So this is where you will get some positive cash flow, and slowly you will eat away that cash which you have kept for this idea to fructify, right? So these are typically research grants or some money which you have won in the hackathons, or maybe your own money which you have saved. That is where the journey starts. Then you start to get some kind of development grants, like it can be from a institution, it can be from an incubator, it can be from any other thing, right? That is where you get some initial fund or money. You spend that money further, you develop it, and then you go to the proof of concept stage where you are trying to create your MVP, minimum viable product. You'll need some more money now, and you would have exhausted your own money doing the initial roaming around, identifying about it, talking to people, etc. And that is where you need more money. You go to somebody to raise that money, and that is where you will go to your friend and family, and maybe you'll identify some co-founder who will wanting to invest in you, etc. And that is a place where this money will be used to create that MVP. Now you will see, the moment you get into an MVP, you will realize that your cash flow have started to become negative. What is the net cash flow? Net cash flow is how much money you are spending versus how much money you are getting. So now you have stopped getting money. So you took whatever money you can take from your family. Now you are investing all that money in creating that MVP, in creating that minimum viable product. That is where your money starts to deplete. You get into a red zone. This is the red zone, and this the red zone, which is below the line, continues as you progress further. Because what is that you're chasing? You're chasing growth. When you're chasing growth, there's no profitability. When there's no profitability, you will always be in red, which means you will spend more than what you earn. If you spend more than what you earn, then you will always be in trouble, which means for you to be able to run the business next year, you will need more money because you have spent more than what you have earned, which means there are some bills which you are not able to pay, and therefore some money is required to be able to you to pay those pending bills. Where that money comes from? That money comes from the next stage of funding. That money will again come from the next stage of funding. But the question which might come to your mind, that if there is no money, if there is negative cash flow, then why do somebody push so hard to make sales? Why can't you reduce your sales? Why can't you sell only those products which people are willing to pay higher and sell them? And the answer to all of it is in the nature of funding. What is the nature of funding? Let's say somebody who is your angel investor. They invested in you some money and you promised them that I'll give you 5x growth in 3 years. Now, see, somebody who comes into a shaky business which has not yet established, who will come into your business? Those who have good understanding of a domain. So always remember that angel investors, they're called angels just because they come and save you or invest in you at the time when nobody else is willing to invest in you. Why do they do that? Just because they are experts. They are experts in that domain. They're using their own money. It is not a aggregated money. This is their own money which they're investing in a company, and they are confident. They feel less risk than others just because they have domain expertise, right? And therefore they're called angel investors. Now these angel investors do not want to be with you for the lifetime. They have invested in you. You don't do that, right? You invest in a stock. You don't keep that stock for your entire life. You will sell at some point in time because you want a return. You want to realize that return, and then use that money or money earned in that investment for some other purposes you have. So like similarly, angel investors are taking a lot of risk. When they're taking a lot of risk, they want good return. Reliance Industries Limited or TCS today may be in startup at some point in time, but today they are not giving you 2x, 3x, 5x return. They're just giving you 10% return, which is not even 1x, right? So 10% return year on year, if I have to take, then why don't I go and invest in TCS? Why do I need to go and invest in a risky business like a startup? So if I invest in a risky business like startup, my expectation of return will be many folds. And if I wait with that company for many, many years, then their return, their ability to generate return is going to go down substantially. And that is where there's a mismatch between my expectation and what I'll get out of it. And therefore, the angel investors don't want to stick with you for your lifetime. So they want liquidity. They want to get out of your business. So what they will do, they will force you, because you don't have money. You are in negative. When you don't have money, how will you be able to repay them their entire amount? So they will force you, they will convince you, they will persuade you to go and raise the next round of funding. Why do they do that? So that you have enough money at one shot with which you can pay them and they can take an exit and go out of your business. And then with whatever is left with them in the fundraise, use that money to grow further. So it is their growth. The hunger for growth is not their intrinsic motivation all the time. Many times it is the push which is given by the investors, and that is why they are not looking at profitability, rather they are looking at growth. Right? Sir, go to the next slide. Now let me talk about, because this small story may help you clarify a lot of things around it, right? So since I'm not able to write it on the screen now because my screen is not shared, let me just tell you the story. If you have a pen and paper in front of you, you may want to write it so that you remember what I'm saying. So let's talk about two students. It's the story of two students, two young engineering dynamic students of IIT Hyderabad. They both, let's call them Mr. A and Mr. B. Mr. A is a traditional department, from a traditional department like mechanical or metallurgy engineering, while Mr. B has chosen a very new aged engineering department. I don't know if you have in your engineering college or not, but you would have heard of it, biomedical engineering, right? Which is basically biology, medical science, and engineering combined together. They teach, certain things which is to develop equipments, etc., machinery, which is very much related to medical space. So these engineers are experts into that domain because they understand body well, they understand biology well, they understand medical well, and therefore they will know the requirement of the domain well. So these two graduates attended a workshop which was on entrepreneurship. They were very excited. They wanted to start something of their own. They were thinking on some ideas. And what happened when they graduated, this fellow, which is Mr. A, he started a business of, producing ball bearings. What he realized that, in his area where he come from, government has created a new SEZ, which is tax-free zone for businesses to thrive, or reduced liability on businesses to thrive. They have created an SEZ for the auto sector, and suddenly a lot of auto and manufacturing sector companies have started to put their shops around that zone, and this has created a lot of demand for ball bearings, which are getting shipped from, let's say, 1,000 kilometers away from the city, and therefore he sees that there's a lot of shipment cost which gets added to the ball bearing cost when it reaches the final consumers or the producers who are using it. Since I know of a very latest Japanese technology which was delivered by a lecture given by a Japanese professor who was here for some conference, and basis that I have an idea that how can I do it in a little cost-effective way. The current ball bearing manufacturing, if they have 20% return, I can generate 30% return because that's an improved way of producing ball bearing. And with that, my efficiencies will be better, and therefore my cost of production will be lower, and therefore I can generate 30%. Second, I'll be very closer to the SEZ with a new plant, with a new high-tech plant. So maybe they will, it will be cheaper for me to go and penetrate the market. So others, if they are able to sell, let's say 80 rupees per unit, maybe I'll be able to sell it at 70 rupees per unit, and therefore I'll have a bigger market here or bigger market share here, and therefore I'll go about it. Sounds good? Now let's talk about Mr. B. Mr. B, on the other hand, is a biomedical engineer, as I said. He also listened to a Japanese professor. Let's for the time being assume that IIT Hyderabad have a lot of collaboration on technical front with some Japanese institution, and therefore faculty come and go from that institution to have IIT Hyderabad. So another Japanese faculty came and he talked about some research they are doing about nano robots, right? Nano robots. So now using the same carbon nanofiber. They have created nanorobots, and nanorobots are very, very, very small in size, so small that it can be dissolved in water and you will not be able to see them. So they're saying that we can create a lot of nanorobots, and these nanorobots can do a lot of cell repair within the body. So let's say that you have some kind of ulcer in your stomach, you just need to swallow a pill, and that pill will go inside your body. That will come out of the capsule, and then within your stomach and your intestinal tract, it will go and repair those damaged cell wherever there is a problem. And then in 2-3 days, it will disintegrate itself and come out of your body, either through different channels, right? So it comes after your body without any giving you any pain, etc. Sounds very interesting, right? But now what he wants to do, he wants to use the same nanorobo concept which the Japanese professor talked about to cure blood cancer. He wants to inject it into the bloodstream of patients who are suffering from leukemia. And this nanorobots will be able to, using some kind of sensors which you have thought of, will be able to identify the cells which are not good, hold them, treat them, and leave them. And the medicine will remain in your bloodstream for 72 hours and then disintegrate by itself. By then, they would have cured all the cells which are cancerous in your body, especially in the blood, and that will help reduce the effect of cancer on you. Now, both of them, to be able to do what they are trying to do, which means create their MVP or create their product which is workable, needs around 50 lakh rupees of investment, and that is after which they should be able to sell whatever they are manufacturing. Now they go to the bank, right? Now my question is, at this point in time, what will they do? Will they go for equity funding or they will go for debt funding? Anyone? I mean, are the participants allowed to speak?
Participants are not allowed.
Okay, no worries. See, at this point, what will happen when you want to go and raise 50 lakh rupees as a funding for you? Will you go for equity or will you go for debt? This is the first question. Now let's understand what is equity and what is debt. Equity is something where you are giving partnership to somebody. So if somebody is giving you this 50 lakh rupees, they will have, let's say, 50% ownership in your company or 30% ownership in your company, which means now from this 50 lakh, starting from this 50 lakh, and maybe you have your own 10-20 lakhs from your friend and family, etc. You have started this business which you defined it worth, let's say 1 crore rupees of today, and then you started to grow, you started to make more money, and the business grew. So with this 50 lakh rupees, now 3 years have passed and you have started to make 5 crores per year with almost 20% margin, which will mean almost 1 crore of profit you are making per year. Now, how much will go to this investor who had given you 50 lakh rupees? If his equity percentage was 30 for that 50 lakh rupees he gave you, which means 30 lakh rupees from every crore you earn will go to this individual, and it will not only stop there, it will continue to go to him in for perpetuity, because they are a owner in your company, a shareholder in your company, and therefore their benefits are going to be perpetual, but the money which they gave you was one time. So the point is that why shall I give away a share of my pie to somebody who is just giving me money? So as a owner of a company which I'm trying to establish, make big, I know tomorrow it will be very big. So a small percentage today of 30% will only come in 50 lakh rupees. But after 10 years, the same 30% of my company will be worth almost 500 crore rupees. And therefore, I don't want to give away everything to somebody else for my effort which I am putting, right? So what do I do? What do I do then? I will generally want to raise debt in such cases, which means what is debt? Debt is, let's say, a bank loan, right? which means I am saying that does not matter. I earn 10 lakh, I earn 20 lakh, I earn 30 lakh. I will only repay that 50 lakh which I have taken from you. In what fashion? In the way we have agreed upon. What is that we have agreed upon? That every year you will pay me 10% interest, and at the end of 30 years you will pay me my total principal which you have taken. So if I have taken a term loan of 50 lakh rupees, I am asking you, that I'm telling you that I agree to pay you, let's say 10% interest every year till the next 20 years or 30 years for which I have taken the money. And at the end of the 30th year, I'll repay your 50 lakh rupees which you initially gave me. So even if I assume that there's 10% of interest on the loan which you have taken, which means how much are you going to pay? You're going to pay only 5 lakh rupees per year, right? So your business need to just earn more than 5 lakh rupees per year to be able to repay that money. You're getting this point? Now, out of A and B, who is more likely to generate this 5 lakh year on year? Of course, the ball bearing, because it's a tested business, right? It's a tested business where I'm just trying to bring some efficiency. Even my efficiency does not come, which is saying that my margin will be 30%. Even if the efficiency does not come, my margin still will be 20%, which is the standard in the industry, which will mean that the likelihood that I will generate a cash flow in the next year and onwards is much higher in a business like ball bearing, because if I go to nano robo, sounds very interesting. If they're successful, they can make you multimillionaire and billionaire also. But what if it does not succeed? Even if it succeeds, it may take 2 years, 3 years, or even 5 years for it to cross all the lab tests, all the regulatory permissions before it gets injected into the body of a patient. So therefore, I don't know, as a bank or as a lender, I am not cared about how much money you can make. I am only cared about how much money you have promised me to repay. So even if either the business of Mr. A or Mr. B makes 5 lakh as the profit in the next year, or they make 5 crore as a profit in the next year, I know as a bank I'm just going to get what? My 5 lakh rupees which you had promised me to pay interest year on year. So does it matter for me to go and invest in the other business which is of the nano robots? No. Even if they become successful, even if they become big, my contribution from their company is going to be only 5 lakh rupees, which was promised by them. So it does not matter. But where is the risk? In which one of them, between A and B, the risk is higher? The risk is higher for businesses which are with B, because I don't know. This may become successful in terms of technicality of it, but the moment I go for clinical trials or regulatory approvals, the regulatory body may not allow the nano robots to be injected in the bloodstream. But what if it caused something else which we are not sure about, and therefore we don't give you permission? It is not accepted. There can be so many things which may may see as a problem, and may not really fructify. It may not really work. So what do we do? So as a lender, as a startup, I want to take loan. I don't want to take equity. Trust me, as a startup, you will never want to take equity. But the problem is, if you look at these two businesses, the ball bearing business, both of them want to take loan from the bank, but the banker is not very sure about the proposal which was submitted by Mr. B, which is a nano robot. They don't know. They don't understand this, right? If I have to compare your project with the old project, yes, I have a reference for ball bearing project which I can look at and see what kind of margins typically ball bearing make. But whatever you are claiming, whatever you are saying, I don't know that does it exist or not? Will it be done or not? Is it feasible or not? And therefore, as a banker, I am not at all interested in you, because my upside is fixed. So it does not matter. You make 5 lakh, you make 50 lakh, you make 5 crore. I am only going to get 5 lakhs. So better to stick with a business where the probability of getting this 5 lakh is much higher than the one where the probability is not higher of getting whatever little money which is being promised to me. So always remember there is something called as pecking order, which means it was a famous paper of 1984 by Myers and Majlov in the New York University. So they basically talk about this concept of pecking order in the paper, where they're saying that any business or any founder will always want to first use their own money because that's the cheapest money. What is the cost of your capital? Which when it is your own money, this is opportunity cost. If you did not invest in this business, you would have maybe invested in the market, Nifty B, or maybe Infosys, or maybe TCS. So you may have earned 10, 11, 12% return on this. So that's the opportunity cost. That's the cheapest money with you. The next level of funding or costly funding is the debt funding, right? So you will first want to use your own money. If your own money is exhausted, you will go for a debt funding. And if either you are not able to get debt funding or you are done with whatever debt funding you have to take, then only you'll go for equity, because you should be always forced to take equity rather than just first option as equity. So always remember, as a startup, always go and ask this question, that can I take care of my funding requirement through my own money or just by taking loan? I have seen many startups which do not require, because they may be startup just because they are bringing some innovation in the process or the technology, but their business model is proven. They don't have to wait for multi years. They don't have to wait to spend a lot of money into their business before they start making money. So when you have started making money, which means the cash flow which is guaranteed to you, you can always go and take loan. You don't have to go for equity. Never go raise unnecessarily angel investment and VC investment, because they are very painful. So what do? You go and raise debt funding. But in this case, what is happening? When Mr. B goes to the bank, the banker is not willing to give them 50 lakh rupees, because what it is very risky. I'll give you, what if you are not able to? What if your business does not get successful? What if your medicine does not get approval? What if you are not actually able to complete what you are trying to do? What if after even the medicine comes, the acceptance of it is very low? So there can be so many problems which I don't know, which may exist. And therefore, what do? I say that I am better off paying to Mr. A this 50 lakh rupees, but I'll not fund your project. So I'll get unfunded and remain unfunded, and that is where I will go and raise equity, right? So go to the next slide, sir. So raising equity is not the first option or most preferred option. Rather, it is the last option which you should have. Now, when it's coming to equity capital can be of two in nature. One, your own money which you put internally, yourself, your friends and family, or the bootstrap money, which means whatever profitability is there. So who owns the profitability of the company? The owner of the company. So let's say the company had 10 lakh of profit. So that 10 lakh of profit should be given to me as a shareholder as dividend if the company did not use it for something else. If I don't want to give dividend, then what I'll do, I'll use that 10 lakh money and employ it back in my own business so that my business can grow. So that is called bootstrapping, right? So it can be your own internal money, either self or friends and family, or bootstrapping, any one of them, which is the first preferred equity investment. Then comes the debt, and the third one is external equity. Now, external equity can come in the form of, as we discussed, it can come in the form of micro seed round, like coming from accelerator, incubator, or micro VC. It can be seed round. It can be Series A, B, C, D, after Series A, certainly, or it can be PA investment. It may culminate into an IPO when we come to the secondary market. Or sometimes it can come through crowdfunding also. I'll talk about crowdfunding a little more in detail. But in Indian context, crowdfunding through equity is not yet allowed. Government is working on some regulation, but crowdfunding, P2P lending, which we call, which means crowdfunded debt, which you can always take, right? Okay, let's go to the next slide. Now, coming to sources of non-equity funding, the example which I give you, the term loan, it can come in the form of a term loan. It can come in the form of trade credit. It can come in the form of commercial bank financing, especially for your working capital, etc. For factoring as in, is basically selling your invoices to somebody else, which means, let's say you did a business with some Chola and Chola companies. Now, Chola and Chola companies uh, had an agreement with you that if you do this work for them, they will pay you something, right? Uh, let's say some money they were supposed to pay you for the work which you did for the company. Let's say in tune of 5 lakh rupees. Now, when you raise that invoice to them for them to pay you that 5 lakh rupees, it may happen that all the money is going to come at once, or the kind of engagement is such where the money comes to you in part today, some part tomorrow, and some part later on. Or else the money will only come after 2 months when your consignment reaches to them, they put it on, deploy them into the ground, and explore it if it is working the way they wanted it or not. And then only they were willing to pay you, which means for some period your money will get stuck. Your money will get stuck. You will not have enough money to be able to pick up the next item because you need to buy raw material. You need to invest in those resources. So what is that we do? We want our cash flow to come quickly, but the company is not willing to pay quickly because they have a process to follow. So what do? I sell my invoice to a bank, and the bank will say, okay, this invoice is worth 100 rupees. I'm good at doing wasuli. I can go and get the money back from the company because we have set processes with which we operate. But now from today, I will be the legal owner of this debt contract, right? So I am the one who is into this debt contract with them, which means I will recover the money from them, whichever they have committed. But I, as a company, or a financial institution, is only providing you this hedge, given that I earn something out of it. So what is that I earn? So if your invoice is worth rupees 100, I will say that give it to me at rupees 98 today, so that when I recover 100 rupees tomorrow from the client, I will have 2 rupees of profit. That is what the factoring does. Is it good? It is very good for startups because it gives them enough cash flows in their hand, which they don't have to get tied up to one invoice, right? So they can do next items they want to do. It can be in the form of equipment loan, it can be in the form of plant improvement loans, etc. Next slide, sir. Yeah. Now coming to the other capital, apart from debt and equity, there are other ways in which you can get capital. One, I talked about crowdfunding, which is sometime it can be categorized as debt type of funding or equity side of funding. But then again, crowdfunding is a little different than simple fundraising, and grants, which typically come from incubators, etc. So next slide. So what I'll do is, I know I'm kind of because we could start little late. I'm little over time, but let me just take another 5 to 7 minutes, and then we will kind of wind this up. I'll take you to the steps of startup fundraising. There are 7 key stages of this fundraising, and why it is important for you to know. See, assessing the need for funding is the first step, right? One, that you as a startup first need to assess that what is that you need money for, right? So you need to develop a clear plan, and which is milestone based, with some timelines that, okay, I need 10 lakh rupees because I want to buy equipment on the second month. Then I need another worth 5 lakh rupees equipment. Then I need another equipment of 1 lakh rupees in the 7th month. Maybe by December, I'll need another 3 lakh rupees, and so on and so forth. So that kind of understanding and that money for what is important to know for you to be able to fundraise. That's the first thing. Have clear financial projections. Always never go with 1 year of budget. This is my budget. You talk about how it's going to grow, how it's going to look like in next year, how it's going to look like in the subsequent year, and so on and so forth. So advisable at least advisable that you create as much as you can, at least. But again, financial projections above and beyond 5 years does not make a lot of sense. Some people sometimes use 10-year projections also, but typically 3 to 5 years is a good time for you to make a clear financial projections and know exactly how much required and what for what purpose do you need that. it is very important for you to understand this point. You know, that you don't just because you have access to funding does not mean you go and raise any money. Because they will not expect you to just pay their money back. They will expect you to pay their money back after making it 2x, right, or 3x or 5x, which will mean they're looking for return. So the money which is coming to you has to have a return which they generate out of it, right? So that is very important, that how much you require and for what purpose. Next is assigning the investment readiness. Look from the investor's lens. That is the first important point. Sorry, that's the first important point. It is important for you to assess the investment readiness, right? Your investment readiness. How is it done? You have to wear the investor's hat, think like an investor, and ask this question. You know, you may like to raise, but has your venture matured to a stage where investors find confident in investing, right? If they don't find it, then you are in a problem. So what you need to assess? You need to assess this. You need to assess if your revenue growth and market projections are in order or not, right? What kind of favorable returns on investment can you give with somebody who will go to give you money? Time to break even and what kind of profitability you're looking at the time after which you'll break even, uniqueness of startups and competitive advantage, and then maybe the entrepreneur's vision and future plans, etc. So this is important for you to assessing your investment readiness. That how do I be ready for that? So next slide, please. Next is preparation of a pitch deck. It is important for you to know that a pitch deck should not talk about everything and anything which you want to include. Be very rest assured that these, preparation of pitch deck will have to have a story, right? One, there's few elements of it which you need to know before you get into pitching somewhere for fundraising. The first and foremost thing that it has to have at least story, and a core purpose. If you just put nuggets in the box and go in front of the investors, they may not like it. But if you put a story, weave a story around it, that why do we have to do it and what can it create, what impact does it create, then it makes a lot more sense because it will remember it, right? The key components to include in the story are these. I'm not saying these are the specific exact slides which you want to. Some cases you may not have a very specific template of the slide which you want to create, or maybe a wall, So it is important for you to understand that depending on the nature of the business, sometime the same template may not work, but more and less, these are some of the very important or must-have points which you should have on that presentation, right? The first one is the team. Team is one of the most important factors, right? If you do not have a good team, then investors are not willing to invest in your money, no matter how good your idea is. The second one is the issue of pain point that your product and solution addresses, right? This is very important. That what solution are you trying to find out for a problem, so that we know about the problem and also the solution which you're proposing in the right set, right? So that should come into the pitch deck as a story, right? The next one is business model. Simple, keep it simple. And what does it mean? It means who will pay for and in which form, and what is that they will pay you for whatever the product and service which you're trying to develop. Similarly, if you look at the other components which are needed is market, the business model, the size of the market opportunity, the current traction which your business have, how much growth have you shown, financials of the current and projections, which are very important. As I said, minimal 3 years. funding need is a very important thing. You cannot just go to raise fund without actually knowing how much do you need, right? So funding need and what for it is to be used, and the current equity structure, that who owns the company, how much do you own in the company, etc. Right? So that is also very important for us to understand, right? So these are the basic constituents of a pitch deck. So you have to have a good pitch deck which have a story. Next step, sir. Next slide. Yes, the next is investor targeting. It is very important for you to target the right investor. For example, if you are in an early stage and you go and target a VC, the VC may not be very comfortable investing in you because they may have more money, but their problem is that their expertise is not domain. Domain expertise come from, for example, let's say the same example A and B, right? Mr. A was trying to do ball bearing, Mr. B was trying to do nano robots. Now, if you go and pitch it in front of the investor, again, the ball bearing thing is known to everyone, and therefore they will be comfortable investing in it. But everybody will be very doubtful about the other one. Who can have little bit of confidence? Will it work or not? Think of an individual who had worked in a Japanese industry where people are experimenting with nanorobots in the medical space, and they have their own money, right? So while working in Japan, he was paid a lot of money in terms of salary, a few $100,000 per year, and therefore he has made a lot of money. So now they have understanding of the domain. They also have their own money. Nobody can come and shout that why did you invest? Why did you eat that ice cream? Right? It is your own money. You can invest. You can waste. Your next generation is also settled. You don't have liabilities. You have reached a stage in your career where you don't want any more thing. But what you want to do, you want to create a fortune and leave it for your next generation. And that is where you are looking for these early investment opportunities, in which you can multiply the money, not only 0.3x, 0.4x, but rather you can multiply your money by 3x to 4x. That is where they come into picture. And why do they come? Because they have better understanding of the domain, they have expertise. And therefore they don't only give money, they also give you advisory that how to deal with this. So these are the people. So identify the right funder. If you are at an early stage, you are into a very complex domain which is not easy for others to understand, always look for angel investors rather than VCs. But if you have crossed that stage, you have done your MVP, you are ready to go into the market, you just need money to kind of scale up, take it to the other cities, then VCs are good people to look at an investment opportunity, right? The investment thesis, you need to prepare. What is this investment thesis? So one, identify these people, identify their stage, that, for example, some fund may want to only invest in early stage, some fund only want to invest in pre-seed round. So try to understand which stage they invest in, what is the geographical focus, do they have any sectoral focus, etc., etc. Do your homework to understand active investors, their sector preference, geographic location, and average ticket size. You cannot go for raising 5 crore fund from a venture capitalist or angel investor, which typically invest in 10 to 12 lakh space, right? So it's unnecessary that you get into somebody who has a different ticket size. And somebody, for example, somebody who only invests in 5 crore, 10 crore, 15 crore, and if you go asking for 5 lakh rupees as funding, it's a waste of time for them, and therefore it's a loss of opportunity in which they would have invested and focused on a venture which is of that scale and size. So next slide. So investor targeting is very important. The next important aspect is, yes, the next slide, valuation and deal structuring, right? Establishing the valuation. We can talk about it sometime.
Sir, shall I share?
Sorry?
Shall I change the slide?
No, this is fine, sir. This slide is fine. So we can talk about it sometime later whenever we meet, because that itself is subject into it. Although I have a couple of things which I've included in the slide, but understanding your valuation is very important. You cannot leave it on to others to value you. You need to understand how the valuation is done. But again, that valuation does not mean कि मेरा बच्चा सबसे सुंदर. No, You have to understand that what is the value which your business have and how this valuation is done from an investor point of view. They may have a different assumptions while they make, you may have a very different assumption, and therefore your valuation numbers may not agree. Think of it, when you have to buy something from a shopkeeper, the shopkeeper may have a value, you may have a different value for the item. You bargain and then you both agree at some point. This is what the deal structuring is done. Do you want to give it a common equity? Do you want to give it preferred equity? If they're not very comfortable, can it be a CCD? Can it be a comfortable convertible notes? Or it can be, some kind of debt investment in the form of royalty which you pay them from your revenue. So that is deal structuring which has to happen. So you need to put your valuation correct in that format, and also may indicate that what is that you want, in what format do you want to raise it. Due diligence by invested investors. Try to understand beforehand the key elements which is required by them to scrutinize you before giving you money. Even if they like you, they like your idea, but then they will look at a lot of documentation before they'll give you money. Keep those documentation ready, understand what kind of due diligence is required from that kind of investors. And then finalization of term sheet. It is important, right? So what kind of valuation goes into term sheet, and this is something which you will do after your deal is struck, right? So this is in a nutshell what steps we need to take for fundraising. So go to the next slide. Sir, next slide, please. Yeah. So understand this. What do investors look for in startups, especially when they're trying to invest? In a nutshell, I'll just summarize it. Objective and problem solving, right? What is the objective? What is the problem you're trying to solve? It has to be very clear. Scalability and sustainability. When I say scalability, your business should be scalable. You're doing something which is very much dependent on you. You cannot replicate it at multiple places. It's a waste of money for them. It's a waste of time for them, because you cannot give them 7x, 10x, 5x return, right? So scalability is very important. And sustainability, which means it sounds good, but will it continue? Will it sustain? Will it work in this way? Or the moment somebody else starts to doing it, your margin in the business goes down, or you don't have enough customers to take your product, service, etc. So scalability and sustainability is the second most important thing. Then comes the market landscape. How does it look like? Are you too early into the business? Are you too late into the business? How does the competitive landscape looks, etc. Customers and suppliers and their competitive analysis, right? What kind of competitors are there? What kind of customers are we looking at? What is the profiling of that customer segment which you're looking at? What kind of vendors we have to be able to make what we are making or deliver what we want to deliver, etc. Sales and marketing, what kind of money do I need to invest in these activities, and your own financial assessment. And last but not the least, exit avenues. Your pitch, your funding plan should have an exit opportunity for the funders who will be joining you at this point in time and leave you at the end. So, and just to conclude, it is very important for you or for us as founders of a startup to understand that we should be in a model where we are into a model where we are doing something very innovative, very new. If we are not doing very innovative, very new, which means I shall get funded through equity funding. Through debt funding. I don't unnecessarily need to go chasing equity funding, because if I'm not doing something very unique, very innovative, the likelihood that I'll get a bank loan is much higher. If I'm able to get a bank loan, why do you unnecessarily want to raise equity, right? So go and do the bank loan. What if you do not have enough, confidence of the banker or the debt financer into your business that you will be able to generate that cash flow to be able to repay their interest, or will be able to repay them, or will become successful, etc. Then, or you may not have enough collaterals to get the loan. Then what you need to do, you are forced to take equity funding. When you are forced to take equity funding, what do? You will first want to understand that how much money do I really need, how much, and then go with a very solid plan identify the plan in terms of what is the money you need, why do you need it, and with that money, what kind of growth can you show them, right? Then identify the right set of investors. Understand always that if you're early stage, you need a lot of expertise in the domain. Go for angel investor. If not, go for VC funding. Again, when you go there, try to understand that you go to the right set of funders. Don't go to anyone, because many of these funders have a domain focus. They may have a specific requirement in terms of what kind of ticket size they fund. Always remember that the most important thing which the investors look at is your scalability, sustainability, your team, and the exit option which you give them. Then it is also important for you to have a financial plan which is ready with you, and you should be ready to kind of weigh between these two different options which is thrown to you and strike a deal with them, right? So you have to have some flexibility that, okay, you don't give plain equity, you can give me money in terms of royalty, or you can give me in terms of a CCD, compulsory convertible debentures, or maybe convertible notes, etc. So there are many forms in which you can take the money, but you should know why you need that money, from whom you need that money, and what will you do with that money, and when will you give these existing investors an option to exit, which means when is your next round of funding going to be, so that they know that when you raise the next round of funding, we can take a partial exit at that point in time. Maybe 75% of the shares which I own in a company, I will sell and go away, because you have raised that fund, you have that fund to pay me. I'll sell the shares back to you, I'll go away, right? And you can use that money, rest of our money, to chase growth. See, the valuation of startup is not based on bottom line, because they are not profitable. Their valuation is done on the top line, which is the revenue. So therefore, growth is what the startups always chase, and they chase it because they have to give exit to their previous funder so that the next funder can come on board. So therefore, their target is not profitability, their target is always growth, right? But nevertheless, with different cycles of the market, the focus of growth being the basis of valuation versus your gross margin being the basis of valuation keeps changing. Especially after the breakage of, the default of SoftBank, the Silicon Valley Bank, and again the lower interest of soft banks and some of the bigger banks which were investing a lot into these startups. Now these VC funders and angel investors, they have started to look for bottom line based valuation rather than a top line based valuation. So such cycles will change certain aspects, the way the valuation is done, but more or less it is important for you to understand which is the right set of investors, why do they invest in my business, and what is that I have for them in terms of exit, in terms of growth, right? If that is not clear, nobody is willing to invest in a business, right? Idea does not give you money 99.9% of the time. It is idea plus your ability to execute, right, with the right set of team. So that is important. So that's all. I think we have kind of reached the time in which you have to conclude. So I'll just stop here. If you have any questions, I'll be happy to take. Otherwise, that's all from my side. All the very best to all of you. So 2 minutes, I'll call you. So 2 minutes, I'll just finish your call. Yes.
Sir, pretty much. Sir, am I audible, sir?
Yes, you are, but there's some echo which is there.
1 minute.
I think you have two devices in the same room.
Yes, sir.
That's why the echo is there.
Am I audible now, sir?
Yes, sir. Yes, sir.
Sir, thank you for this excellent session for us, sir. Basically, students, I asked some of the students to chat if they are having any doubts. One thing is they are asking that what is this particular specialty in crowdfunding, sir, especially? Is the basic importance of the crowdfunding?
Crowdfunding, yes. Yeah, so crowdfunding, especially, there are two kind of ventures which typically will get into crowdfunding domain. One, if you are a social venture and you may not have enough growth prospects, you may not have enough return in the business which you do, but what you do has a lot of social impact which it can have. That is where you will not find any angel investors or VC interested, because for them the return is important. If they put 100 rupees, they want 30 rupees back within a year. If that kind of business you don't have, then they may not be very interested in it. But there are a lot of people who are married to the cause. For example, let's say you are doing something which will clean the air or drinking water or remove the problem of plastic. You are a venture, you are doing something, but it's not very profitable. But people are willing to give you money for that cause, and that is where the crowdfunding comes into picture. Or else you are doing something which is very unique, very innovative, which only few set of people understand. A lot of people do not understand because it has a very different flavor, very different understanding. So investors don't believe in it, but yes, there exists some set of people who believe in such a product or service. For example, let's say you want to create uh, something which may sound like a taboo in the society, but then there are a set of people who are actually looking for product and services for that. So it's very difficult for you to go and convince an investor to invest in that. But you know that there, in the dark web there are a lot of people who are it's not a criminal thing, but it may be a social taboo, or it may be not very accepted thing which your product or service is offering. But there are a set of people who are actually looking for such innovative product and solution, and therefore you may go to a crowd funded platform where you showcase it and give them some benefits of getting it early on, and that is where they buy it from you directly. So like a pre-buy or equity investment in your fund, or maybe debt investment in your fund with a small amount. So rather than looking at one big fish investing in your company, you are looking for small people investing in your company with a small contribution and with a promise that you will return that contribution to them. So crowdfunding can be profit type and not for profit type as well, where there are some crowdfunding platform where people only donate money without expectation of a return for certain cause. And what is that? Their expectation of return is that you fulfill that obligation of the cause which you are going to, the impact which you are going to create, etc. So there are many crowdfunding platforms. Indiegogo is there. Then Kickstarter is there. So these are some of the big names in the crowdfunding or crowdsourcing space. There are some Indian variants of this also. You would have heard of Keto. Keto is both for startup and for some social cause. Likewise, there are many other, crowdfunding platforms which are coming up. And as we go forward, more and more such platforms will come up. So that's also a good idea. If you're not getting funding, you're not able to convince a lot of investors at different forum, then you may take a shot with crowdfunding platforms as well. Sometimes it does give you that kind of traction.
Sir, some of the students have asked different types of questions, and I will share them through mail for you, sir.
Okay, sure.
And all the required necessary documents, etc., I will send by Saturday, sir, because we will conduct a series of lectures. As I told you, I have sent you already.
Certainly.
Saturday, this is the last lecture for us, sir.
Okay.
On this particular day, we will send all the feedbacks as well as the appreciation letters as well as necessary documents that are which we have already discussed with Panda sir.
Okay, sir.
Harshini, I request you to give the vote of thanks.
Sure, sir. Thank you. Good afternoon, all. I, Sai Harshini, on behalf of Raghu Engineering College, taking the opportunity to give vote of thanks for today's session. I express my heartfelt gratitude to Shamim Javed, sir, for his enlightening guidance throughout the journey of angel investment, finding opportunities for early stage entrepreneurs. His unwavering support has illuminated our path and propelled us towards creating innovative solutions. Sir, well explained what are the requirements for fundraising and for what that are required for startups, and what are the requirements such as prototype creation, product development, team hiring, raw materials and equipment, etc. Sir, well delivered. What are the stages of startup that are required in a life cycle? That is idea, proof of concept, business model, validation stage, product market fit, growth, scale up, and Mr. Javed sir's dedication to fostering creativity and excellence has been truly remarkable. Uh, I extend my gratitude to Mr. Javed sir for sharing his knowledge. I also thank our organizing committee, Dr. Srinivas sir, K. Satyam Naidu sir, and Dr. A.V.S. Swati ma'am for organizing such workshops, which are useful to shape our success. Thank you, sir. Thank you, one and all.
Thank you.
Can we stop over here, sir?
Okay. Thank you, sir.
Thank you.